Now, there is no such thing as a free lunch, is one of the oldest cliches available. So you're about to earn your lunch by listening to what is styled the hard truths and opportunities about investing in Scotland. We're going to have, this is in two parts, we're going to have a preamble from one of our key founders, MarktoMarket. Doug Lawson is here to reprise what he was sharing with us last year. He's then going to effortlessly segue into the panel discussion, which Barry McCulloch from British Business Bank will host, which has Mark Munro from Scottish National Investment Bank, Aidan McMillan from Power Equity, and Gemma Hamilton from British Growth Fund. So, ladies and gentlemen, first of all, welcome Doug to the stage.
Thank you very much, and thanks for having me here, especially Alan and Investor Scale for giving me an opportunity to talk about this. So, yeah, this is just a wee appetizer for the main discussion, and what I'd like to talk about here is the empirical data to illustrate what's going on in the market. And this data comes from MarktoMarket, which is a company I founded after I worked in venture and growth capital, and then became a public company fund manager. And what MarktoMarket does is it's a SaaS-based platform to access data on private companies, particularly small private companies, where the data is particularly difficult to find and to source. So this is the data sets that we collect, and what I'm really going to focus on to illustrate what's going on in the market at the moment and what's going on in Scotland relative to the rest of the UK is the dark blue box, which is fundraising events. So we collect the information on every private capital fundraising event that happens in the UK above. We have a cut-off of £50,000. So that's what I'm going to that's what I'm going to talk about here to show you how things are trending at the moment. And so the data goes back to, for the purposes of this analysis, data goes back to 2019. UK registered companies raised over £50,000. So that's 27,000 events. Some caveats. It's equity only, so we collect some information on debt, but that's a wee bit harder to get. So this analysis looks at equity. It's primary, it's new money only. 2023 data is provisional. Sometimes we have to make estimates, and we don't make any adjustments on the valuation side for any pref shares or anything like that. So if any of the data looks dodgy, that's me absolved of any guilt. This is how we segment the data, or this is how I've segmented the data for this. So I know that everybody has different definitions of what constitutes a seed round or a Series A round or whatever. This is the way that we've done it for the purposes of this. So the smallest raises we call friends and families. That's 50 to 250k raises. Pre-seed is 250 to 1 million. Seed 1 to 3, Series A 3 to 10, Series B plus is 10 million plus. So we don't do Series B, Series C, and so on, because the sample size just get very small. So I'm afraid we've just lumped it all into Series B plus. And then in terms of the territories, you can obviously slice and dice this down to postcodes and cities and so on. But again, for the purposes of this, we look at Scotland relative to London and the southeast relative to the rest of the UK. So this is the total number of fundraising events going back to 2019 by vintage, by year. The bar over on the right-hand side is just annualized 2023 data. So we haven't done anything clever there apart from annualize what we've got so far. And I think the first observation, or the observation I would have in terms of how 2023 is trending at the moment, is that it's well down on 2021 and 2022, which won't come as a great surprise to anybody. But it's actually relatively healthy when you compare it to pre-2021 levels, which may be a little surprising to some. Now, I think this is maybe more illustrative of the current market. So this is looking at, rather than looking at the number of events, this is looking at gross capital raised per annum. And at the moment, the UK, so at the moment we're trending towards about 10 billion in 2023. And that compares to 21 billion last year, 33 billion in 2021. And even when you go back further to 2020, you're looking at 17 billion. So, we're well down in terms of the gross capital raise. So that it feels a bit strange that the number of events, yes, it's fallen, but probably 25, 30%, but the gross capital raised is down very, very materially. So in order to understand that, what we can do is we can start to drill down in each year into these different buckets. So into the pre-seed, seed, etc., Series A and so on buckets. The green bars are the ones I think to focus on here. So each of these groupings represents one of our buckets, and each of the bars within the groupings is the years from 2019 to 2023 year to date, 2023 annualized. And I think that what the most interesting part of this is when you look at Series B+, you can see that the number of events is trending down, whereas in 2023, if you look at the green bars, actually at other stages, it looks okay. So that's number of events. Now, if we look at it through the prism of capital raised, a completely different story. So if we look over to the right-hand side of this chart at Series B, you can see that we're estimating 4.7 billion of Series B capital raised for 2023, which you can see is materially down on 21-22, no surprise, but also materially down on 2020 and actually 2019 as well. So the pain has been taken in, the larger the round size you go towards, the fewer have been happening, and therefore the less capital has been raised, and actually the median size of those rounds has been falling as well. So if we now look at Scotland specifically, so this is replicating the last two slides, but rather than looking at the UK as a whole, this is looking just at Scotland. So friends and family to Series B+, and you can see here, so the green bar, 2023 annualized. In terms of number of events, friends and family looks reasonably robust. Same with pre-seed. Seed looks okay. Series A actually looks reasonably good in terms of number of events. Series B plus is well down. So similar story in Scotland to the rest of the UK in terms of the number of events, falling number of events as the round size increases. And then this is really stark. So this is Scotland total capital raised rather than number of events. Again, friends and family on the left, Series B on the right. And you can see in terms of the capital raised, actually from friends and family to Series A, the health is okay. It's Series B plus where we're massively underperforming relative to previous years. Now, so we can see that the number of deals happening at the larger end of the market, I think sort of the broad definition of scale up here is 10 million plus. So those Series B plus deals are falling, the number of deals and the amount of capital being raised. But how are we doing in Scotland relative to the rest of the UK? So what this chart does is, so starting at friends and family, this is the turquoise line at the bottom is Scotland's share of that market. So Scotland's getting sort of 4 to 5% of the friends and family market, 50 to 250k check sizes. The rest of the UK gets about 40%, and London gets the balance. So Scotland gets 4 or 5% of the friends and family activity. Pre-seed, very similar. Scotland gets 4 to 5% of that. Seed, very similar, a wee bit more, 5 to 6%. Series A, 4 to 5%. And then Series B plus, 1 to 2%. So what this is saying is that Scotland is massively under-indexing on the larger check sizes, on the 10 million plus check sizes. And if we look at this, if we take a year in isolation, what we can look at this time, what we're looking at is the round sizes along the horizontal axis there, from friends and family to Series B. And each of these lines represents a territory. So the turquoise line at the bottom is Scotland, London is the line at the top. And what this is telling us is that as round sizes increase, the share of the market that goes to London and the southeast increases. As round sizes increase, the share that goes to Scotland falls, and falls materially. Some recent deals in Scotland, be familiar with some of these, I'm just going to move on here. So this is pre-money valuations this time. And what we often get asked by our customers is, how do valuations vary, or do valuations vary on a regional basis? And the answer is, well, they do. And this is looking at 2022 in isolation. And so the turquoise bars in each of these groupings is Scotland, the dark blue is London and the southeast, purple is the rest of the UK. So starting on the left-hand side, the median pre-money valuation of a Scottish business raising friends and family money is 1.4 million versus 2 million for a London business. And this is, as I said at the start, this is none of this is adjusted for any pref shares or any other kind of preferential instruments. At pre-seed, it's 3.2 pre-money valuation, median pre-money valuation versus 4.2 in London, 4.9 versus 8 at seed stage, 14.8 versus 17.1 at Series A and Series B. Sample size are quite small, but irrespective of the year that you take to look at this analysis, you'll see a material discount for companies in Scotland. So you get more bang for your buck in Scotland in terms of valuations. This just shows the discount across the different stages. So the purple bars, that's Scottish deals relative to London and Southeast deals. So friends and family, it's a 30% discount in terms of median pre-money valuations, 24% at pre-seed, 39% at seed and Series B. That's looking at 2022. But again, you would see a very similar trend irrespective of the year that you take to look at that. So this is maybe a slightly crude measure, but this is just saying, okay, well, it's clear that most of that capital, we're getting 5% of the pre-Series B capital in Scottish companies, but is it a problem with company creation? So what we're looking at here is the pounds invested per new business created. So it's not pounds invested per business funded, it's just looking at the number of companies that are created since 1st of January 2019 in Scotland versus London and the southeast. So it's a consistent measure. Scotland's on 21,000, London and the southeast is 65, and it's getting worse. Last year it was 15 and 47. So I think the key takeaways here, first of all, overall, investment activity, I think the rhetoric in the newspapers is that it's all a complete disaster. And I think the newspapers over-index on the big stuff that's happening, and it's clear that that's well down. But actually, at the kind of very early stage to seed stage, the activity is reasonably healthy. Once you get to Series A, it's a bit weaker, and then Series B is materially weaker. Also, check sizes within Series A and Series B have been shrinking. So that's not just Scotland, that's across the UK. If you look at median check sizes in those buckets, they have been falling this year relative to previous years. Scotland's massively underrepresented in allocation of capital, especially in the Series B pot. So we get, well, on the latest numbers have us tracking about 1% of that pot versus 4 to 6% at previous stages. And £3 of capital invested per new company formed in London and the southeast for every £1 in Scotland. And finally, Scottish startup and scale-up valuations at big discounts to London and the southeast. And that's been the case for some time. That's a situation that persists. And that's all I have to say, really. Thank you very much.
panellists come up. That was excellent, Doug. I have to confess, I started by thinking it was a delicious appetizer, and then by the end of it, it started to stick in the throat a little bit. That second last bullet point from the key takeaway, that is pretty brutal, isn't it? But worry not, because look at the panelists we've got to make sense of it all. And we've been here for a few hours. We've heard from a lot, but now it's trying to make sense of it, where the market is, where it's going, where the opportunities are, but where perhaps our weaknesses are, and joined by some excellent panelists. And we're just going to introduce everyone before we move on. So I'll just start with you, Gemma.
Morning, afternoon, everyone. I'm Gemma Hamilton from BGF. I'm part of the Edinburgh team, and we cover Scotland and Northern Ireland. I've been at BGF 10 years now. Basically, we focus on growing SMEs across the UK and Ireland, and we predominantly focus on kind of established businesses, so turnover about 3 million plus, up to 100 million. It's not your stereotypical Series A, Series B investor. Very much focused on growth businesses, and hopefully some in the room today. We typically invest between 1 and 20 million, and we're slightly different to your sort of traditional private equity in that we're always a minority investor and a long-term investor.
Over to you, Mark.
Thank you. Good afternoon. Mark Munro, CIO, Scottish National Investment Bank. By background, sort of corporate investment banker of a couple of decades in some. Across multiple organisations and locations across Scotland, the UK and the US as well. The Scottish National Investment Bank has been capitalised with £2 billion over 10 years and is established as Scotland's mission-led development bank. The bank's been created to address Scotland's grand challenges. One is a climate emergency, the changing demographics of society, as well as the growing inequality we see across society. We're not established as an investor of last resort. We are established as a provider of growth capital. I think that's quite important. The bank, on the back of those grand challenges I spoke of, has been set 3 missions. We can invest debt, equity or funds between £1 to £50 million, so quite a wide range. But if you think of the missions, then we do need that wide ticket range. When it comes to returns, we have 2 returns that I need to get. I need a return, a commercial return. I also need an impact return. That is in this, as opposed to do no harm. It's about creating change in Scotland. For example, we want to create careers, not jobs. In the just shy of 3 years the bank's been established, we've invested over 460 million and crowded in over £700 million into 29 assets.
Aidan?
Yep. Hi, afternoon everyone, and happy Halloween. I'm Aidan McMillan. I'm an investment director with Par Equity in Edinburgh. And I've had the privilege of working with companies like Current Health, OptiScribe, Speech Graphics, Integrated Graphene, and a number of others over the last 5 years. For those of you that don't know Par Equity, we're an Edinburgh-based venture capital business. We've been around since 2008, originally set up as an angel syndicate to back innovative companies in the north of the UK. And in the last few weeks, we've also announced the launch of our new institutional venture fund, which is a £100 million fund backed by LPs such as SNIB, thanks Mark, BBI, part of BBB, thanks Barry, and I see Poonam in the audience, thanks to Strathclyde University as well, and Strathclyde Pension Fund. So the fund was set up, obviously I've heard this morning lots of people talk about the funding gap that exists between kind of 5 to 20 million, which we find is the kind of most critical funding amount that a company needs to raise to scale up. And that's why we've raised it at this point. I'll go into a bit about what we like about the north of the UK and Scotland in terms of the company and the ecosystem later on. But just to provide some more data to Doug's presentation, we've actually seen data that suggests that London-based companies receive almost 15 million of funding on average versus less than 2 million in Scotland and the north of the UK, which is about an 8x difference. So you can clearly see the reason why we've set out to raise this fund.
So lots to talk about. There's been a sense this year that the FOMO's been replaced by tumbleweed. You can almost see it here. A lot of the orthodoxy suggests it has been a quiet market. Having heard from Doug, and we'll let that seep in a little bit. Coming to you, Mark, what have you made of the market this year?
I want to be positive, but I think the reality is it's a very difficult market to raise money. We have a high inflation. I was going to say high interest rates, but are they relatively high or not? That's maybe something else we could discuss another day. And we have significant geopolitical uncertainty. That doesn't mean transactions haven't been happening. What we're finding is they're taking a lot longer to execute. The execution risk is higher in the sense that we've been involved in processes where some have even gone through investment committees and not been able to conclude, which has meant the sort of old adage of until you sign, then it's not guaranteed. Where we sit with the hopper, so I want to finish my bit here on a positive, is we are extremely busy. We have a very full hopper, which is encouraging. The bank invested £220 million last year, and we will invest at least that level in this year. So there are lots of opportunities. It's just taking longer, and it means we just need to work a little bit harder.
Aidan, it's been a quiet time at Par. Not much going on.
Definitely not. It's been a busy few months, obviously with the fund launch, and then with lots of companies reaching out to us after the fund launch. So I think we've been extremely busy, and before that we've been continuing to make new investments in the likes of Neuranics, Glasgow-based university spin-out. We've co-invested with BGF for the first time into our portfolio company Artis. We've co-invested with SNIB into Cycom and Verloom this year as well, and we're also working quite busily on the first two investments out of our new fund at the moment. So I would say it's not slowed down at all for us.
Gemma?
Sorry to choose Aidan, but I'm probably going to go with Mark in this one. I would say the first half of the year has been slow. It's been a lot slower than the previous years. And I think when you look at Mark's slides, we did have a COVID bounce. I don't think anyone can get away from that. There was that COVID bounce. But to your point, Mark, people are stopping, are reassessing what their plans are. And that's because of being hit with energy costs, supplier costs, staffing, what's going on in the world. It's just constant. And I think I'm certainly seeing a lot of companies are going, I'll wait and see what so-and-so does, and I'll see who goes first. And then I'm hoping that will drive deal flow, though. And if you look, and again, to your point, Mark, to end on a kind of positive note, I would say H2 this year has started to pick up. We've continued to back our portfolio companies. We've got a dental chain that's still acquiring businesses out there, backed an early stage tech business up in Aberdeen, Stella Armada, our IT consultancy business. So there are deals happening. I just think, to your point, Aidan, it's still taking a bit longer. My prediction is H1 next year is still going to be a wee bit slow. I think a lot of companies are still sort of pausing, seeing what's going to happen. But I'd like to think, we're in this new norm now. People need to adjust, and that's what makes the good entrepreneurs. They just go, do you know what, we just have to get on with this now.
Yeah, there's clearly been a reset. You saw that in Doug's slides, where there's been a bit of a reset to a more normal cycle, I suppose, given the unsustainability of what happened in 21-22. So from an investor's perspective, would you say that the slowdown's been a good thing?
Well, as I said, I've not really seen the slowdown, but I would say that the wider kind of market slowdown has been a good thing. Obviously, I think in the kind of post-COVID exuberance, there was when capital was cheap. I think there was quite a lot of poor behaviours, both from investors, companies, kind of driving up valuations, raising too much money when they're too early to raise, and pursuing a kind of growth at all cost approach. And I believe that in this market, founders and investors need to kind of illustrate a little bit more discipline in what they do to avoid the mistakes of the past. And I think that's a great thing for investors looking to invest. I think in 2008, after 2008, there was a lot of really, really good sustainable businesses built off the back of the discipline that came in after that. And I think we're probably going to see that over the next 5 to 10 years as well.
Yeah, I was just going to add, I agree with that, and I think we saw valuations going up. And if I'm being honest, we didn't play in that side of the market because just wasn't for us, and maybe we're just tight Scots and being a bit frugal, but it was just, and we'd rather wait and see what the market turns out to be. And we saw this back in 2016 when Brexit hit, and we actually had our busiest week of investment. And again, we saw it when COVID hit. People just shut down shop, but for us, because we're long-term investors, we could say, well, actually, these are still quality businesses coming through. But I think the market is sort of setting now back to that kind of new norm and driving the right behaviours, as Aidan sort of alluded to.
You referenced that in your comments, Mark. How are things at the bank?
Very well. They're going really well. And what I'd add, similar point, is we're also a minority investor, but we're also a patient investor. So just as an example, when it comes to our equity investments, it means we can take that 5 or 7 year investment horizon, maybe rather than what may be traditional 3 to 5, similar to BGF, and I think that's important, that stability. I suppose my message to potential investees is to sort of focus on the fundamentals if I can, and that would be around, and that's not to be condescending, please don't take it as a condescending tone, but that's around sort of focusing on the team, getting as much out of the team, understanding the markets and being agile to the changes because of that uncertainty I referred to, and sort of deliver on a sensible plan. And I think it's really important that it's a sensible plan, you can show some progress to that.
When we came in, you probably saw this inscribed in the walls, that Scotland's great at early stage, but weak at scaling companies. You know, it's almost like something we preach to ourselves, and we could dig into that a lot. But I think for this session, what I'm keen to hear your thoughts on is the extent to which, you know, as investors, do you have that quality deal flow at that level? You know, often we hear the founder's perspective, but I mean, how do you see things? You know, is the deal flow there for bigger deals, and is the quality there? And I'll just kick off with you, Aidan.
Yeah, I would agree that the deal flow is there and the quality deals are there. I think we've, obviously part of our thesis of our new fund is the fact that there's 50% more identifiable scale-ups in the north of the UK, and that about 9% of funding, VC funding in the UK goes to companies in the north of the UK, whereas 70% goes to London. So we do think that there's the scale-up opportunities there, and we're definitely seeing and speaking to founders at the moment that we're quite excited about for the future.
Gemma?
I'm not going to lie, Doug, your slides did depress me a wee bit. I mean, so our average check size is about 78 million. I sort of alluded to earlier, we're not traditional Series B, and again, I'll just be very honest here, the challenges we faced when you're getting to that Series B is we find when we're backing businesses, they're looking for a lot of money, and for us to take a minority stake, it gets a bit tight, if I'm being honest. We've also seen management teams so diluted that for us it's all about that team. Mark's alluded to it. As a minority investor, it's all about that existing team that we're backing. And if they're sitting there with 10% of the equity, it does become a challenge for us. So we have to be adventurous to see how can we make this work? How can we get that existing team incentivized, but keeping all the other investors happy as well? And again, the other thing we've sort of certainly seen, and look, just to be clear, our job's up here. We're here to do deals in the market. So with Doug's slides, and sorry if I'm giving you a hard time, Doug, but that is bad news for us because we're here to do deals and we want to do deals and we want to find the right companies. One challenge we found is we're trying to back growing businesses, but there's no visibility for us on that kind of getting to profit, cash generation. It's just, I'm just going to keep going, and before you know it, it's 6-7 years and they're still not turning a profit. And that might be fine for some businesses, but certainly from a BGF perspective, it is tricky for us. So that's been the barriers that we have seen in the market. But look, again, Aidan, I'm doing a sales pitch for you. Your new fund is there to fill this gap. And from our perspective, we're certainly going to be watching the companies you back, looking to go invest, as we have done with yourselves, to see these businesses really scale, because that is what they're needing. Mark?
Not that much to add, except that there's three organisations up here trying to change the statistics that we just seen on the presentation. If it's helpful, I can reiterate what we look for in that sort of scale up. I will say as well, I'm looking at some of the team here, and they give me the wink. We are working on investments that would sort of qualify under the Series B definition that we just seen. But just to reiterate, the management and the board is so important. And if we get in, and I'm not being personal, I think we all need to be honest, and it really starts with being honest about yourself, about the team and the business. And then when it comes to the management and the board, we need that to have accountability and and some tension as well, is quite healthy, so that accountability is held. Ideally, there's probably some experience of sort of commercialising a business plan. So to Gemma's point, it might not be quite at the stage of, or maybe cash flow positive, but they know how to get there. The quality of information is really important. As heard earlier, someone mentioned advisors. Advisors, through their deal craft, and no Halloween pun intended, can add some value, and we shouldn't discourage that as well. And then the other point, just to reiterate what I've been saying, is around just the management team. Sometimes the management teams and the board can change, and that's not a bad thing. You know, as the businesses are at different stages, from maybe that Series A to the Series B, I think we just need to be brave, and sometimes those decisions and discussions need to occur.
Sticking with that practical side and what companies can do to be investor ready, are there any tips, looking at you, Aidan, and then Gemma, that you would give? Are they things that you often see founders and management teams do that you think, if only you tweaked this, if only you dialed that down, that the outcome would be different?
Yeah, definitely. I think Shane mentioned quite a lot about first principles, so I won't touch on any of that. I think obviously we've talked about how tricky this market is. I think for raising funds, I think the data did that justice. But it's been tricky for founders to really understand what is acceptable to investors, what's going to get them that scale-up funding. Obviously, I think these days investors, especially at the Series A stage, are looking for companies that are generating much more material revenue, have much more revenue pipeline and conviction, better unit economics and capital efficiency. Whereas in the past, there was businesses getting funded that didn't have any of that. And I think obviously those things that I've just mentioned are all really, really good things, but for founders to really be able to adapt to that new norm quickly, I think you really need to be able to get used to adapting and changing effectively and quickly. And I think to your point about the team and stuff, I think building people that have into your team that have got situational experience, have been through downturns, been through ups and downs and stuff, will be able to help you with that.
Anything to add, Gemma?
I think being honest around, so if you're looking for further funding, being honest with your new investors or people you're pitching to, what have you done with your money that you've raised to date? Have you delivered your plan? Have you sort of grown into your next investment round? What has changed? Because that will give a new investor comfort. You know what you're doing, you've executed well, and it gives us comfort, I suppose, that you're going to continue doing what you're doing. And I think the other thing, again, just from our experience, is just being honest with us around what funding you require, and always build in a bit of contingency, but also just what further funding do you think you'll need in 2 years' time, 4 years' time, and actually being really, really clear around that, because, being blunt, investors don't really like surprises. So just being clear, and actually it allows other investors to plan accordingly, and making sure you've got the right capital structure for your company going forward.
Barry, can I just add on top of that, is also the Kool-Aid test. Robust information is important, especially financial information. But having considered assumptions, just to the points that both Aidan and Gemma are making, is really, really important. I know one of the themes later today is space. And so often we see sort of space shuttle launch type numbers, sometimes within a month of the business receiving capital. And that's not a good place to start the conversation.
Agreed. So just sticking with BGF and Partners for a second, you're both active in other parts of the UK market. How do you view Scotland's place in that UK market? Because there's a lot of growth happening in the northwest in England and in Northern Ireland. And often we focus on the London and the southeast piece, but there's a lot of other hungry areas of the UK out there. I mean, how do you feel like we compare and contrast?
Yeah, I think we're doing a good job. I would say, well, 70% of BGF's investments is out with London, so that's a big tick for me. And then I was actually looking at comparing our portfolio in Scotland to the rest of the country, and we perform really well. I look at the returns, I look at how our portfolio is performing, and look, this is all down to the management teams we back. That is a big positive for me. I think we're a bit quieter, or sorry, where we're not doing so well is we've got a lot of quality companies in Scotland that we don't scream and shout about. Now, we back a lot of family-owned businesses, they keep their head down, and they are treating really well. And I'm not talking about the next unicorn here. Yes, that's great if we get more of that in Scotland. For me, you know, it's companies that are going from startup to 30 million turnover, employing a lot of people, they exit well, but then they just keep their head down and don't talk about it. And I go, we need these people out and about, you know, inspiring the next new leaders, but actually just recognising the success and what they're bringing to the country. So I sound a bit patriotic, but yeah, I think Scotland is doing well, and I'd obviously love to see more of that coming through.
Yeah, I would agree with that. Obviously, we also invest in other places around the north of the UK. So 65% of our portfolio is in Scotland, but we've got a great bunch of companies over in Northern Ireland and a growing portfolio in the north of England. I think because our fund focuses in the north of the UK, I'll probably just take them as a collective. And I think we're really excited about the north of the UK. I think the key reasons for that are the north of the UK is rich in manufacturing history. It's rich in inventors, particularly in Scotland. There's great universities and academic institutions that have world-class R&D facilities, which obviously helps with spinning out talent and great companies spinning out into the ecosystem. I think also away from London in the southeast, there's obviously a lower kind of business running cost environment, which to Doug's point earlier, you can get a lot more bang for your buck up here, I think. And I think with all that, that means for the investors that are here, there's not too many of us at the moment. I think there are beneficial valuation implications that brings, because we're the ones on the ground. For example, one of our portfolio companies, a great portfolio company that will remain nameless, is approximately 1/6 of the valuation of a competitor based in the Golden Triangle that has an inferior product and lower traction. So we're seeing great companies up here, but for better value. I think one area that we would want to see the ecosystem kind of develop over the next few years is we need to have more big outcomes. We need to have more Skyscanners. We need to have more Current Healths, Optos, various others to really put Scotland and the north of the UK on the map and bring that international investor and acquirer attention to Scotland. And the final thing I'll say, I've only been in the sector for 5 years, but I'm amazed about how things have progressed in the last 5 years, particularly most recently with BBB's and SNIB's commitments to the regions. So I'm really excited about where things are going to go in the next 5 years.
Just picking up that point, Aidan, and then coming to you, Mark. We've been looking at the market as it was and thinking about what will happen next. How's the pipeline for next year?
Oh, sorry.
With you, Mark.
You said, it remains very strong. The bank's had something like will be nearly 1,000 opportunities passed over our desk in just under 3 years. We've had 29 investments, 40 if you include the follow-ons. Unfortunately, we probably say no more than we wish, but the pipeline is strong. I'm very comfortable saying that we will at least make the 220 that we made last year in commitments in the year coming ahead. And given the headwinds we spoke of, I think that's really strong, because it was maybe a fair market last year. So it's a lot of good work by the team at the bank.
And notwithstanding the Scottish cringe that you talked about and our inability to sometimes celebrate our successes, how are things shaping up next year for you, Gemma?
Yeah, I said earlier, I think each one will still be quietish, but for me, when we meet companies, it's sometimes 2 years, 4 years before we do a deal. So I'm actually really encouraged by our pipeline of companies that we have that relationship with, and it's all just about the timing. So actually, I'm pretty encouraged by it.
And for you, Aidan, I mean, you touched on, the need for more exits. How do we reach that tipping point? I mean, obviously your first ever institutional VC fund is going to play a part in that. But how do you see things shaping up next year?
Well, in terms of pipeline, it's obviously been through the roof since an announcement a few weeks ago. So there's some great companies that we're speaking to, and we're really looking forward to that. Yeah, sorry. Was there another question?
No, that's perfect.
Can I add though, Barry?
Yeah, of course you can.
There's a point I think that's important here. Aidan touched upon the last 5 years. I think the conversation, and it's part of the exits, I think the conversation starts to change now from about the availability of capital to that investor readiness. The bank's established, BGF's very well established, and it has a fantastic role. We've seen BBB with £150 million committed to Scotland through the Investment Scotland Fund. We now have the PAR Fund. There was also a Foresight Fund raised earlier this year. So there's an enormous amount of capital now available. I'm hoping that gets into the businesses, and then we can start to see the exits. Scotland's had 200, 300, 400 years of entrepreneurialism, and we've seen that with the references to Skyscanner and Current Health as a more sort of modern additions to that, and there's more to come.
That seems like a perfect moment to just pause and ask the audience if we have any questions. I see a chap just at the back. I think there's two.
Hello. Might make me a bit unpopular, the question, because I think it's provocative, but am I the only one that thinks there's a bit of a contradiction in what you're saying from a point of view of wanting to see bigger exits, which we all do, and everything that we want in terms of the success of numbers and deal flow and everything that we want to see in Scotland, versus what seems to be quite an aggressive list of dating requirements that you're putting in very early stage startups? EBITDA profitable, unit economics that are high growth, great contribution margins, really great solid management teams, experienced if possible. Do you not think that there's a problem with the risk appetite that the investment community has with pre-Series B? And how are you expecting to actually get the results that we want, which is much more successful startups, when your dating criteria is going up? And a lot of people don't get the luck that we had when we raised.
Who wants to take that one on first? Thank you. Thank you.
I'm
just going to pass this on quickly. Mark?
Yeah, I'll set Aidan up for this one. No, there's something in maybe what you're saying, but if you go back to one of the comments I made around, say, the management teams, I did say there can be gaps, and that's important as long as we're aware of where the gaps are, and thereby it's about working with the teams. So the Scottish National Investment Bank, we are subject to sub-state control, which generally means that there's been a market failure. Deep inhale of breath when we say market failure, but it's maybe not, it's quite scary once we get below it. But what it generally means is that a business has been able to raise the capital it wishes to. We can demonstrate that. Thereby, we know that we're going to have to work with the teams and make it a journey together. So okay, that might be the end game, but we need to be comfortable that that's what can be delivered, and we need to see the signs of everything that's been set out when we're having those conversations. So maybe it's the way it's communicated. I'll let the others answer for themselves. We're not asking for it on necessarily on day one. If we could, great, but we know it's not. And if I look at the bank's been around just under 3 years. I would argue we've worked with a lot of our portfolio companies. We worked with BGF on one or two where have maybe been a bit more challenged, and I think they're in good place just now. So maybe in the ideal world that's what it is, but we're very aware that there's a journey to be had. We just need to have the sight of a lot of maybe these requirements and metrics that have been pointed out.
Yeah, it's a great question, Federico. Thank you. I think from our perspective, obviously we feel that the ecosystem is strong and it's well served by angels from the early stage, angel syndicates. We've got an angel syndicate as part of our business model as well. I think after the funding amount exceeds a certain amount, though, we are capped out, and that's obviously why we're keen to launch our fund and get it out there. One thing I didn't mention, though, is we are quite keen to work with investors outside of the north of the UK and learn from them about what they've experienced in their journeys with companies, and potentially if there's learnings to be had on risk appetite, we're hopeful that this could be a conduit for that to take place as well.
So I think there was another one at the back. Wow. So there's a chap at the back, then I'll come to you at the front. Worry not, sir. In the jumper, I'll come to you next.
Hi, guys. Thanks very much for the really good discussion. I was just going to talk about, or ask you about terms to some degree. So Mark, you've talked about sort of 100 million here and 100 million here, there, which compared to the 4.5 billion gap we were talking about this morning, I think really barely kind of scratches the surface. And the reality is we have an oligopoly of investors in that kind of scale-up space in Scotland, which means that terms can be incredibly hard on any business. So what I see right now is, if you were to look at a term sheet 10 years ago to a term sheet now, you'd see a massive transformation. And actually internationally, you'd see at the same time, and therefore got a huge amount of empathy for it, valuations going through the roof, and therefore vendor expectation being very high, which is what those terms are countering of preference shares. But also we're seeing really punitive fees, really punitive monitoring. Like there's just opportunism at every opportunity, because there's a lack of competition of VCs in Scotland in this space. What we're also seeing from the brilliant MarktoMarket slides is actually valuations here haven't done what things have done in the States and all the rest of it, and yet terms have. So given, I would think, as an oligopoly, there is a responsibility to behave in a certain way in a small broken market, or be unbroken by something like SNIB to reset terms. Do you think term sheets will go back to where they were 10 years ago, or should we keep hyping up valuations, and should management keep hyping up their valuations to exist like the rest of the world?
So term sheets, the oligopolistic tendencies of the equity market in Scotland. Gemma, I'm going to look at you first.
Yeah, no problem. I mean, look, from our perspective, we're very open about our terms. Probably most people in this room have seen our term sheets, which are fine. We're very clear why we've got certain terms. And look, this is very specific to different types of investors, from the early stage where it's much higher risk to, let's say, BGF at a slightly later stage. So I think we have to acknowledge that the investors have to balance the risk and reward when they're looking at all investments, and their terms will match that. I mean, Shane, I can only talk from our perspective, but if we have certain terms in there, we want to sit down with our management teams and explain why we have them. We want to be fair as much as possible. Do I think they'll go back to where they were 10 years ago? I don't. I think we're in a different world now. I think there'll always be people trying to push terms to meet management's expectations and valuations. I think it will evolve over time. I know people hate this when they go, but that's the market, when certain terms come into space. I think as investors, we need to continually challenge ourselves to make sure we're not saying that, and saying this is why we're putting these terms in place and the reasons why, so management understand. And again, I think it's the onus is on all of us as well to educate. Federico, you sort of said when you went into when you looked to first raise, it was all new to you. So I think the more and more people are speaking about the terms, what it means, and educating the management teams who are back and that don't have that experience will help. So I don't know if I've answered your question, but I probably did. I don't think it's going to go back to what it was 10 years ago.
Mark, Aidan?
Sure, I'm very conscious we're in a higher cost of capital environment, and there's so much uncertainty around that I find it difficult to comment at the moment on that higher cost. In terms of the bank, though, Shane, I think it's important. I go back to a comment I made at the outset around us having sort of two returns on our capital, that we do seek a commercial return, but also an impact return. And thereby, I feel that gives us a responsibility to make sure there's some form of equilibrium. Now, I'm not saying I'm going to sit here today and go one way or another on whether we seek greater impact against maybe a particular return. We're open to that conversation. The other part where we will try and influence and drive behaviours, and we are doing that in conversations that we're having at this very moment in time, is that we are a minority investor. And it does mean that we need that additional capital from other sources, which can then sometimes create a Hobson's choice around us sort of continuing to engage or maybe have a negative outcome, or to try and get to an outcome where there is capital deployed, but having tried to influence. So I've taken notes on what you said earlier. I did adjust my notes too around the point of last resort, being an investor of last resort. There may be a perception. I'm keen that we try and challenge that and change it. We do want to be growth capital, but I'm very conscious of the responsibility we have with public capital and a role to try and create and improve markets. There's just one of us. There's others, but it's one step at a time.
Aidan?
Yeah, and finally on that, I think we can't get away from the fact that at the moment in time that we don't have many institutional investors that are non-EIS funds or VCTs or angel syndicates that can't structure their deals in a certain way. So institutional funds are able to structure their deals in a way to protect their downside risk that investors like angel syndicates and EIS funds are not able to. So that's something what I would just say on term sheets. I think we're hearing of quite a lot of bad behaviours coming from institutional VCs in other parts of the world. So I wouldn't say that the grass is greener elsewhere.
So as chap at the front, you've been very patient. Please after you. We've got no shortage of questions, so take a few in batches.
So as CEO of a company that's right at that point of looking for Series A for a sizable opportunity and the kind of quantum that Mark was talking about, 10 million or something, you know, we keep a really close eye on the initiatives like British Business Bank, BGF, SNIB, and you know what we like is the ethos, right, and the size of the funds that you've got available. But what worries us is if your distribution mechanism changes, and I'm not wanting to point fingers, but does that point of contact now shift to a smaller quantum fund with different ethos and metrics that you guys have? Like you mentioned, growing the economy, jobs. You see, it's a little bit related to the previous question. There's a real dilemma there for SMEs looking at the source of funds.
So just to understand, so you're worried that so BGF, for example, we change direction and say we're only investing in...
No, you hand the funds over to people that don't have your ethos.
I think this is you, Barry.
Yeah, sorry, I'm struggling to understand. Just could you
your
organisations
have massive funds, but you don't necessarily invest just for maximum profit, you know, hammer down the valuations, etc., punitive terms, but you are handing the money over to people that might have a different ethos to you. But you're not handing over massive amounts of it. So as a point of contact back to your funds, of which you have more, you've got more powder, does that still exist for the SMEs, or is the route to access the money in Scotland now through, for instance, PAR or Maven?
This is a big conversation. Do you mind if we take it? I feel like we could go
Straight
back
answers,
and forth.
easy.
And we've only got a couple of minutes. So I've got again Chappett, one row behind you, sir, wearing the dark blazer. Just stand up and project. You'll be fine.
Marvellous. Adam from Cavendish Capital Markets. Question touched on, obviously, valuations quite a bit. Valuations in the public market have been very disappointing this year, driven predominantly by interest rates unlikely to come down anytime soon. So it's just going back to the number of deals, the quantum of the deals there, and to understand from you guys that are seeing it, is it management expectations around valuations that are proving a hurdle to the number of deals getting done, or is it more deal flow related?
I'm happy to answer that. I would say it's a mix. I think we are speaking to a lot of companies, but actually their trading is starting to go like that. So it's the wrong time for them to be doing a deal and the wrong time for us to be doing the deal. But back to our ethos, we're a long-term investor. We pick the right time for them, and there's always going to be that meeting in the middle and valuation. So I would say yes, valuation is important, but I think for me it's the timing for management when they're comfortable in the trading and when they're comfortable to do a deal. Because again, Federico mentioned this earlier, taking on investment is a big decision, and certainly I find a lot of companies I speak to take their time thinking about it. And a big thing I would want people to take away is, You know, pick your investor wisely. Once we're on board, we're on board. And don't quote me on this, but I always go, you know, do you want them in your lives and do we want you in your lives? It's a two-way thing.
We're definitely going to quote you on that. We're just.
I know, don't quote that anymore. But it is, you know, you've got to be with the right investor because once you're in, we're in there for the long term.
So listen, Susan's giving me the eyes
Sorry.
as she does and strike fear into the soul. So I'm just going to wrap things up. You'll be able to find all of us afterwards. I know we didn't get to all of the questions. You know, let's keep it going as we go into the plenary session afterwards. I'm just going to hand over to Michael, but before I do, can you just thank the panelists for their time and their insights?
Thanks, Barry. I think all of us want to be in the huddle at the back of the room when you answer the question you were asked earlier on. Lots of great questions, great challenges, and I think we've earned our lunch. So, ladies and gentlemen, grab your food and get the networking continued. And we'll be back here at 2 o'clock. We have spectacularly overrun due to the richness of the programme, and therefore you get a bit of extra time to network and eat, but 2 o'clock on the dot here.